What if you could sell your business and pay zero in taxes? You could legitimately walk away with life-changing money. Millions of dollars, tens of millions, hundreds of millions. It doesn't matter. If you've gotten to the point where you're ready to sell your business, you can exit and pay zero in taxes. Let me explain. I'm a CPA that saved hundreds of business owners and real estate investors collectively over $10 million in taxes. There's actually a few different ways to exit from your business and pay $0 in taxes. This will work if you've been running either an S-Corp or a C-Corp for at least 3 years, and it might be the greatest win-win strategy in the entirety of the tax code. So what is Section 1042? Section 1042 covers the sale of stock to employee stock ownership plans, aka ESOPs. In short, you can sell a part or all of your business to your employees without having to give them any discount, where they don't even have to put up a dime of their own money, and you walk away legitimately paying $0 in taxes. No gray area. This strategy is directly laid out in the tax code and is heavily incentivized by the government. They want you taking advantage of this. Both Republicans and Democrats have supported incentivizing greater employee ownership and employee reward systems in small business, and this space is only going to get hotter. So how does it work? In the simplest terms, you have to sell qualified securities, aka the shares of your company, and reinvest in qualified replacement property, QRP, and you can defer 100% capital gains on the sale of your business, potentially forever. But QRP can legitimately be almost anything. Fortune 500 stocks, corporate bonds, funding your own new corporation to start your next venture. And QRP is incredibly easy to borrow against at an effective rate of about 1%. Sounds too good to be true? Let's dive into the specifics. We know that in order to avoid paying any capital gains taxes, we have to sell qualified securities and buy qualified replacement property. What would make the shares of your company qualify as qualified securities? Well, there are a couple requirements. You have to have held your shares in your company for at least 3 years. Your company has to have no stock readily tradable on an established securities market, aka your company is not a publicly traded company. And you didn't receive these shares by some unorthodox method such as a government-sponsored retirement plan. Your company has to be a C corporation by the time you're ready to exit. If you've been running your company as an S corporation, that's not a problem. You can turn it into a C corporation by faxing in a form that your accountant could prepare in 20 minutes. That's literally it. I'd imagine that almost all of you watching this video have a business that qualifies or could qualify in the future. The second part comes down to the qualified replacement property that you invest in. So in order to qualify for deferring your capital gains taxes, you must reinvest in the QRP within 12 months post-sale or 3 months prior to the sale. Qualified replacement property has to be the securities of a U.S. corporation with 2 requirements. The corporation can't have passive investment income make up more than 25% of its income, and the corporation has to use more than 50% of its assets in the active conduct of the trade or business. So essentially, it can't be some passive investment company. It has to be a real business that's out there trying to make money. That doesn't mean you have to be involved in the business, although you can be, and that business can be any size, whether it's a massively publicly traded stock or a completely new startup company or anything in between. The investment securities itself can be any of the following: share of stock in a corporation, a bond or note issued by a corporation with interest coupons, or the right to receive a share of stock in a corporation. The first option, shares of stock in a corporation, is pretty self-explanatory. You can go ahead and invest in S&P 500 and watch your money grow without ever having paid a dime in taxes on the sale of your company. As for the second option, a bond or note issued by a corporation, many Fortune 500 corporations have created ESOP bonds specifically for people who need it to buy qualified replacement property. Where a traditional corporate bond might be for 5 or 10 years, an ESOP bond is for 50 years and comes in the form of a floating rate note. That means the interest rate coupon fluctuates and is tied to the market's interest rates, completely neutralizing any interest rate risk that typical fixed rate bonds carry. These bonds are Moody's AA or AAA rated, the highest bond rating out there, because you're literally loaning money to companies like Apple and Microsoft. There's practically no credit risk. If they go under, the entire market is in massive trouble. Given that these bonds are very low risk, banks will typically loan you up to 90% against the bond you hold. Meaning if you need to buy $10 million worth of qualified replacement property and you simply want access to as much liquidity as possible, you could buy $10 million worth of floating rate corporate notes and borrow $9 million at a spread of around 1%. The bonds will pay interest, but you'll have a slightly higher interest rate on your debt. But you can still go out and put the $9 million you just borrowed to work. These 50-year bonds are designed to outlive you. 50 years from now, your kids will have inherited an asset worth $10 million, and when the bond's term is up, they can pay off the $9 million and walk away with $1 million tax-free. And the third option is also pretty slept on, the right to receive a share of stock in a corporation. This leaves the door open for equity kickers on investments like stock warrants and convertible notes on smaller companies and startups that you might want to invest in. So all in all, the opportunities are plentiful, and qualified replacement property is nowhere near as restrictive as it sounds. You'll only recognize gains if you sell the qualified replacement property, but you can simply hold on to this until you die and borrow against the portfolio to access all the liquidity if you need to. It is just another form of build, borrow, die that the wealthiest Americans all follow. Here's the thing. I mentioned before that this is the single greatest win-win scenario in the entire tax code. So what's in it for your employees? Well, if you want to go this route and defer all these taxes we've been talking about, you have to sell at least 30% of the shares of your company to an employee stock option plan, or ESOP. You can think of an ESOP as an employee benefit plan similar to a 401k, except where a 401k 401k goes out and buys shares in a bunch of different companies, the ESOP goes out and buys the shares of your business. But that doesn't mean that all your employees have to all of a sudden come up with the money to buy the business from you. There's plenty of banks and private creditors that are willing to put up the money to fund the transaction where they get paid out of the profits of the company. The crazy thing about it is that these loans don't even require a personal guarantee from you, the seller. Once the bank gets paid off, the profits of the company are free and clear to go into the ESOP, or you in the ESOP if you only sold part of your business. Here's the crazy thing. The ESOP is a non-tax paying entity, and after a small waiting period, which can be as little as 4 years and 2 days, the company can convert back to an S-Corporation, and the company also won't have to pay any taxes. So neither the company nor its new owners, your former employees, ever pay taxes on the profits until they later decide to cash out and sell their shares of the ESOP trust. Imagine how fast a company can grow when it nor its owners ever pay taxes on any profit. But it gets even crazier. These companies are at a massive competitive advantage, and banks are more than willing to loan them money to go out and acquire other businesses. The banks know they'll get paid back much faster by a company that never has to pay any taxes. All of a sudden, your employees are owners in a rapidly growing company scaling at unfathomable speed due to it having a 20 to 50% competitive advantage over their competition simply because they never have to pay taxes. This ESOP holding company is the holy grail of Section 1042, and I think companies like this will become a dominant force across a bunch of different industries over the next few decades. Just as a quick side note, if you want tax help directly from me and my team, who've already helped hundreds of business owners save millions in taxes, book a call with the link in the description. So what are the downsides of selling to an ESOP? Well, there are definitely some administrative costs here to facilitate the ESOP and ongoing maintenance for the benefit plan on behalf of the employees. But they're not necessarily more expensive than the traditional exit from your business. Either way, you can expect to pay substantial legal, broker, and closing fees to exit from your business. There is some complexity, but nothing that some solid advisors can't guide you through. ESOPs have to find a trustee to represent the plan. This costs money, but in theory, a good trustee should represent the employees well and be competent enough to protect their financial interests long after you decide to fully transition away from the company. You don't have free and clear use of the funds from the proceeds of the sale, but you truly can borrow around 90% against a qualified replacement property at an effective rate of around 1%. IRS Section 1042 is truly one of the most slept on sections in the entire tax code, but selling to an ESOP is just one way to exit from your business and pay zero in tax. If you want to learn other ways to exit from your business tax-free, make sure you subscribe and comment any other tax or accounting topics you'd like me to cover. See you in the next video.